In 17th century Holland, the most valuable asset in the world was a flower. The Semper Augustus, with its distinct flame-like stripes, became an exquisite symbol of wealth that seemed to grow out of the earth itself. But the physical trade of bulbs was slow. Planting, growing, and delivery took months, a time frame that couldn't keep up with the manic demand of speculators looking for immediate profit. To solve for speed, traders invented the ace. This was the world's first legal derivative contract. Buyers were no longer paying for a physical bulb to take home. They were paying for the future right to own one. This diagram shows how the market abstracted value. An asset splits into dozens of theoretical contracts. By the mid-1630s, the price curve for these papers detached completely from the physical supply. This vertical spike was driven by traders gambling on price movements, making the asset an afterthought. As the mania spread, ordinary citizens sold their tools and livestock to join the trade. It was a first taste of unregulated financialization, where the mechanics of the trade became more profitable than the object being traded. This created a baseless market. When an asset is detached from its physical utility and traded purely as a contract, the price is no longer governed by supply. It is governed by the collective expectations of the crowd. By the 1920s, a new technology arrived to play the role of the tulip. Radio was a genuine miracle of communication, but on Wall Street, it was a speculative vehicle. Shares in RCA, the leader of the boom, rose from $1.50 to over $600. The valuation grew far faster than the company's ability to manufacture actual hardware. The stock ticker machine turned this growth into a real-time experience. For the first time, an investor could hold the tape and watch their paper wealth tick upward by the minute. This rapid rise was sustained by the greater fool theory. The logic is simple. It doesn't matter if a stock is overpriced today, as long as you believe someone else will be foolish enough to buy it from you at an even higher price tomorrow. In a market driven by this theory, investors stop calculating a company's earnings or assets. They trade exclusively on the momentum of the crowd. Speculation thrives on liquidity. In the 1920s, the system provided a massive influx of unregulated credit, lowering the barrier to the stock market casino. The public used this credit for margin trading. They could buy a stock by paying only 10% of the cost in cash, borrowing the other 90% from their broker. This created a feedback loop. As stock prices rose, investors used their paper gains as collateral to borrow more money, which they used to buy more stock, pushing prices even higher. By 1929, the velocity of trading reached a frantic peak. The floor of the exchange was a scene of constant, high-speed movement as millions of shares shifted in a matter of hours. Beneath the complex mechanics of the exchange, the margin calls and the ticker codes, the market was operating on a foundation of raw enthusiasm. When credit is used to fuel these trades, it connects every investor's debt to the market's performance. It turns a collection of individual bets into a single, fragile bubble. In October 1929, the supply of buyers finally dried up. The realization that there were no greater fools left triggered a massive psychological break. This is the mathematical certainty of mean reversion. Prices that have detached from reality eventually crash back down to meet the fundamental value of the underlying assets. As the selling began, the sheer volume overwhelmed the ticker tape. The machines fell hours behind the actual trades, leaving investors in a vacuum where they couldn't even see how much they were losing. On this chart, you can see the speed of the correction. 5 years of speculative gains were erased in days as the herd attempted to exit the market all at once. The crash was a total collapse of systemic trust. When margin calls couldn't be met, the intricate web of debt that supported the boom shattered. This collapse represents economic gravity asserting itself, a mathematically certain correction of a massive psychological delusion. Wall Street's losses soon moved into the real world. The disappearance of paper wealth meant that the loans supporting the nation's businesses began to fail. As credit vanished, depositors panicked. Long lines formed outside banks as people attempted to withdraw their savings before the institutions collapsed entirely. For the middle class, the systemic failure was absolute. This man, offering a luxury car for $100, is a literal record of the personal ruin caused by the crash. The scale of the suffering shattered the public's confidence in the idea of a self-regulating market. The era of easy money had ended in a national crisis. This trauma created the political will for a more powerful central authority. If the market's internal logic failed this catastrophically, the government would need to intervene. The 1929 crash established the Federal Reserve's role as a permanent stabilizer. It marked the moment the government stepped in to oversee the nation's financial system and attempt to prevent the next cycle of speculative madness. In 1940, London was under siege. The Blitz brought the existential threat of war to the British people, creating an immediate need for societal salvation. Sharing air warden duty on the roof of King's College was John Maynard Keynes, a man who would become the architect of state intervention. Standing on that same roof was Friedrich Hayek. An Austrian exile, Hayek was an absolute defender of free, unmanaged markets. While the world burned around them, these men held opposing views on how to rebuild it. One trusted the guiding hand of the state, the other relied on the decentralized signals of the market. This rooftop meeting was the genesis of an ideological pendulum, a swing between government control and market freedom that still dictates the modern global economy. To understand why state planning won the early argument, we have to go back to 1919. World leaders gathered at Versailles to manage the economic ruins of the First World War. Keynes issued a prophetic warning. Extracting massive financial reparations from a starving Germany would lead to a retaliatory war, destroying European civilization. When the world fell into a global depression, Keynes concluded that free markets had failed. He argued that intelligent government intervention was a moral necessity to manage the peace. Hayek countered that giving planners authority to manage an entire economy concentrated a dangerous, tyrannical level of power in the hands of the few. The trauma of the world wars swung the pendulum toward Keynes, cementing the belief that governments must aggressively manage their economies to survive. In 1944, at Bretton Woods, Keynes officially acted as the architect for a new, globally managed economic system. This system treated the economy like a controllable machine. Governments would spend heavily against the wind, using levers of state capital to prevent cyclical crashes. For 30 years, this model delivered. The post-war era saw high economic growth and a level of employment ought impossible. But as the boom continued, Hayek published The Road to Serfdom. He warned that treating society like a machine would inevitably lead to a loss of personal freedom. While Keynes's plan appeared invincible, its reliance on a few state planners left it vulnerable to economic forces those planners could not predict. By the 1970s, that machine reached a point of catastrophic failure. The world faced a paradox: high inflation combined with high unemployment. This stagflation meant the standard Keynesian levers completely stopped working. Britain became the prime example of this failure. The English disease saw massive labor strikes and uncollected garbage as state planning collapsed under its weight. This failure caused the pendulum to swing aggressively back to Hayek, ushering in a period of deregulation and the selling off of state assets. The end of state-led dominance left a void. It raised a critical question: who would manage the economy during the next inevitable crisis? In the 21st century, democratic institutions and Congress have become largely paralyzed by political dysfunction, unable to enact traditional economic policy. The institution that stepped into this political void to manage the economy was the Federal Reserve. Following the 2008 crash, the Fed initiated an experiment known as easy money. They began injecting trillions of dollars directly into the financial system to prevent a total freeze. This chart shows the mechanic of that policy. Flooding the financial sector with liquidity disproportionately inflates asset prices, while median wage growth stays relatively flat. Instead of these trillions flowing into the real economy, financial institutions often used the liquidity to invest in the very securities the Fed was purchasing. This accumulated wealth in financial markets, while the broader economy struggled. By managing the economy without traditional democratic tools, the Federal Reserve helped engineer an era of extreme wealth inequality. An unelected committee of just 12 people now holds the ultimate burden of the U.S. economy. This concentration of authority brings the narrative back to Hayek's original warning. He argued that isolating power among elite planners would create a system detached from the people it serves. The modern boardroom table has now inherited the same concentration of authority that was once debated on that wartime roof. The Federal Reserve is attempting to fulfill Keynes's dream of a managed economy, but they are doing so with the exact isolated control that Hayek warned would be our road to ruin.
For the last century, global economics has swung like a heavy pendulum. At one extreme, the state controls prices, production, and wages. At the other, the free market dictates winners and losers through harsh discipline. To understand why the pendulum swings, we have to look at ground zero for the modern economic experiment. In 1947, Germany was a shattered landscape. The national economy was completely paralyzed. The Allied occupation forces responded the only way governments knew how. They imposed strict, mandatory price limits on everything from bread to coal. They wanted to protect a vulnerable population. Instead, farmers stopped sending crops to the city. Goods disappeared from shelves. People traded cigarettes and cognac in the black market just to survive. Total state micromanagement could not restart a dead economy. The more the authorities tried to plan the recovery, the more commerce froze. A drastic break from the system was required. That break came from a cigar-smoking economist named Ludwig Erhard. He argued that the Allied price controls were the direct cause of the economic paralysis. In the winter of 1948, Erhard went on the radio and, without asking the Allied authorities, abolished all price controls. General Lucius Clay, the commander of occupied Germany, immediately demanded an explanation. General Clay told Erhard his advisors considered the move a massive mistake. Erhard replied, "Herr General, my advisors tell me the same thing." The results were immediate. The black market evaporated. Goods flooded back into shops. The German economic miracle had begun. Erhard proved that unforgiving market discipline could force an economy back to life. It was a successful proof of concept, yet the rest of the world would ignore the lesson for nearly 3 decades. By the 1970s, countries like Britain were operating under a completely different model. It was the mixed economy, a post-war consensus where the state owned heavy industries like coal, steel, and rail to guarantee full employment. This chart shows the fatal flaw in that model. It plots unemployment against inflation during the 1970s. According to economic consensus, these two metrics should move in opposite directions. Instead, we see them rising rapidly at the exact same time, a paralyzing condition known as stagflation. When inflation and unemployment decoupled from historical norms, the government's tools broke down. Printing money to create jobs only drove prices higher. The government had no lever left to pull. By the end of the decade, the breakdown was physical. Public sector unions walked out. Garbage bags piled high in the middle of London's Leicester Square during what became known as the Winter of Discontent. The labor strikes escalated to every corner of daily life. Even the gravediggers stopped working, leaving the dead unburied in storage facilities. Britain earned a global reputation as the sick man of Europe. The post-war consensus, the idea that the state could smoothly plan and manage the economy, was dead in the streets. The collapse of state-managed stability created a desperate political vacuum. The public was ready for a harsh cure, opening the door for the ruthless free market ideology Ludwig Erhard had championed 30 years prior. That cure arrived in 1979. Margaret Thatcher took power with a clear mandate: weaponize market efficiency to carve out the bloated state industries. Her biggest target was the nationalized coal industry. This led to a massive confrontation between the government and the National Union of Miners, led by the militant Marxist Arthur Scargill. The two sides held entirely incompatible economic worldviews. For the miners, the state-owned pits were about community survival. They were fighting for the dignity of labor and the promise of a guaranteed livelihood. Thatcher applied an unforgiving financial calculus. Most of the state's coal pits were losing money. She argued that taxpayers could no longer subsidize uneconomic industries. The mines had to face harsh market discipline. This was a fight for control. Whoever won the year-long strike would set the direction for the global economy. The pressure on the government was immense. The nation fractured, and mainstream economists publicly demanded that the Prime Minister reverse her harsh fiscal policies to ease the widespread suffering. She refused to back down. Addressing her critics, Thatcher famously declared, "U-turn if you want to.
the ladies not for turning. The government held the line. Eventually, the miners' resolve fractured, and the strike collapsed. The most powerful union in the country was defeated, handing a permanent victory to market forces. But that victory extracted a severe cost. The market efficiency Thatcher championed turned entire working-class communities into derelict industrial wastelands, leaving thousands without prospects. Free market discipline successfully stabilized the nation's finances and broke the grip of stagflation. To achieve that stability, the state permanently sacrificed its industrial working class. By dismantling nationalized industries and breaking the unions, Thatcher shifted the power of the British economy from government halls to the trading floor. When the state retreated from the commanding heights, it left a vacuum that was filled by a massive wave of global financial deregulation. This signaled a move away from physical industry toward a leveraged financial system. Wealth was no longer generated by extracting coal or forging steel, but by moving capital across borders at high speed. Economic advisor Jim Milstein argues that this shift incentivized the corporate sector to prioritize short-term market gains over long-term stability. Corporations began to operate as machines built on high levels of debt. The market discipline used to cure 1970s stagflation created a new dependency. Stripped of state protections, the global economy now required a constant supply of cheap credit to remain solvent. The free market revolution was a Faustian bargain. We traded the stagnation of state control for a system that can only survive by borrowing against the future, landing us in the volatile economic landscape we inhabit today.
In the fall of 2008, the global financial engine seizes up. Credit freezes. Banks stop lending to each other. The blood supply to the world's capitalist body stalls, threatening to pull the entire system into a second Great Depression. With the traditional banking sector paralyzed, the Federal Reserve assumes responsibility for the economy's liquidity. The central bank acts as the emergency stabilizer for a collapsing system. Richard Fisher, then the president of the Fed, recognized that conventional tools were no longer enough. The committee turned to a process called quantitative easing, an intervention Fisher describes as practically alchemy. Under this policy, the central bank creates money out of thin air. By pressing a button, the Fed injects trillions of dollars into the financial system, buying mortgage bonds and government debt to force cash back into the banks. The intervention stops the immediate bleeding. The banking sector survives. However, the rescue establishes a precedent where the economy relies on the printing press to artificially sustain itself. While the rescue stabilizes the ledgers of major financial institutions, the reality outside those boardrooms remains grim. Foreclosures multiply and unemployment spikes as the fresh capital injected into the system fails to reach Main Street. Andrew Huszar, a former Fed official tasked with managing this massive bond-buying program, realized the money was missing its intended target. The goal was to lower interest rates so banks would lend to the public. Instead, the banks acted on their natural incentives. Rather than taking on the risk of issuing mortgages or small business loans, they hoarded the cash. Wall Street firms used the Fed's money to buy the exact same financial assets the central bank was consciously inflating. It became a closed-loop trade, where financial institutions generated guaranteed returns without financing real-world economic activity. The emergency rescue mission became a permanent fixture of the financial system. It resulted in a widening wealth gap between financial assets and real-world economic health. As the 2010s progressed, the immediate crisis faded, yet the emergency measures remained in place. This chart shows the Fed's zero interest rate policy, or ZIRP. Holding borrowing costs near zero provided a sugar high to financial markets. With no yield in safe savings, money flooded into stocks, corporate bonds, and real estate, creating an everything bubble. Investors desperate for returns were pushed further out on the risk spectrum. This drove growth in shadow banking, unregulated corners of the financial system where private equity and hedge funds used massive leverage to manufacture yield. By erasing the cost of money, the central bank broke the market's ability to accurately price risk. The economy operated like a high-stakes casino, where the house covered every loss. This dynamic stretched far beyond Wall Street trading desks. It rewrote the incentives for corporate America. When debt was free, innovating new products or building factories became unappealing compared to financial maneuvers. This chart reveals the shift in corporate priorities. Instead of investing in growth,
Companies borrowed billions in cheap money for the sole purpose of buying back their own stock. Buybacks reduced available shares, driving up stock prices and executive bonuses. The corporate structure grew taller, but failed to generate underlying economic value. Financial engineering replaced actual engineering. The system became dependent on a steady flow of cheap debt from the Federal Reserve to stay standing. By August 2022, consumer prices were climbing at their fastest pace in 40 years. The era of free money hit an inflationary wall. At the annual Economic Symposium in Jackson Hole, Wyoming, Federal Reserve Chairman Jerome Powell delivered a blunt reality check. Powell warned that the Fed would hike interest rates aggressively to kill inflation. He stated that slowing the economy would require sustained pain for both households and businesses. The realization sent a violent shock through the global markets. Investors who had bet on the Fed backing down understood that the zero-interest dopamine hit was over. A financialized system built over 14 years on the assumption that money would always be free was forced into sudden withdrawal. Former FDIC Chair Shayla Bair warned of deep fragility. The banking system has spent a decade forgetting how to navigate actual financial risk. Yet Neil Kashkari, president of the Minneapolis Fed, argued the experiment was necessary. With Congress gridlocked, the central bank was the only tool left to stimulate employment. The consequences were widespread. Public 401ks and retirement accounts grew dependent on the market inflation of the everything bubble. Now, the tide of free money is receding. As the liquidity drains away, it exposes hollowed-out companies and hidden debts submerged for over a decade. The era of paper wealth is ending. Sustaining the economy now requires a return to economic fundamentals, replacing financial engineering with actual investment in physical infrastructure and genuine innovation. As economist Mohamed El-Arian notes, the experiment went far beyond its original mandate. The emergency interventions of 2008 saved the system, but left us to confront the reality of the capitalist structure we built in their wake.